Thank you. Any more quizzes out here? Time is up. Any more quizzes out here? Any more quizzes? I'll take them. Quizzes, quizzes, quizzes. Thank you. Thanks. You don't have to write it in every page unless you took it apart. Okay, any more quizzes out there? Please bring them in. Quizzes, quizzes, quizzes. Okay. No more quizzes out there, right? Okay, so the usual rules apply. By now you know what they are. I said you're done with all the quizzes, right? All that's left is a final exam. Okay? So the usual rules apply. When I'm done grading, and I have a little bit of a logistical glitch on this quiz because I have to leave at about 3 o'clock to get to the airport to catch a flight to Europe. So I'm going to try to get as much done as I can before 3, but I might not get them all done, in which case I might put a portion of the quizzes that are already graded out, and the rest will be with me in Vienna. And you got to hope I get back with the quizzes, but the scores will get recorded. So if you don't get your quiz back this afternoon, I'm apologizing in advance that I have to take them with me to finish the grading, but I'll try to get as many done as I can before 3. So don't be surprised if at 3 you get an email saying A through whatever, or Z through, depending on which side, end of the alphabet I start with, are done, come pick them up. Okay, reminder also that that big project that's been on the back burner, you still need to complete the pricing. So sometime in the next couple of days I'll start to send to-do lists on that so that at least there's not much to do actually, but there are a lot of little things you need to get done. So let's pick up where we left off. We're talking about options. Now, I gave you that very speedy introduction into option pricing. And I'm not an option purist, so if you describe some of the things I say about options to an option purist, he's going to blanch, because the reality is, if you're an option purist, you can never ever really value a real option. So I left you with this notion of a decision tree. Okay? And if you remember statistics or operations research, decision trees are actually very, very effective ways of dealing with a certain kind of risk. If your risk is discrete and sequential, decision trees actually work very well for you. That sounds kind of abstract, discrete and sequential. Let's take the example of a company that's come up with a biotech drug, or any drug, right? It's come up with a drug to treat diabetes. It's just come out of the lab. It's not gone through any of the approval process. 3 stages in the approval process, right? At each stage, you're either going to get a 0 or a 1. You either get approved or you don't. Those are the probabilities, discrete. Sequential, you can't get to stage 2 if you don't get through stage 1. So in fact, what you see here is a decision tree for a very simple drug. It's a diabetes drug, and essentially I map out at every step what the tree looks like and what the probabilities are. The key, of course, to being able to draw this tree is you have to be able to estimate those probabilities at each step. And with pharmaceutical companies, you could argue that they have enough information to be able to do this because they have a larger sample of all the drugs they pushed into stage 1 and how many get approved in stage 2. So it's I think, a technique we underutilize in valuation. So if you gave me a drug to value, I might put it through a decision tree if I feel that is the biggest risk I face, because trying to force this into a discounted cash flow valuation is really tough to do. So open up your operations research or your statistics book, think about decision trees, and decision trees are actually, they come with nodes that are either decision nodes where you get to decide, or probability nodes where the fate gets to decide what happens. Very interesting way of bringing in different risks. And if you can do a full decision tree, you don't have to do real options. Okay? So let me close off with the 3 questions I framed last session. So when I come to you with a real option, the first question you're going to ask is there really an option? So make sure there's an underlying asset. Make sure there's a contingent payoff, if you can draw a payoff diagram. Second step, is there economic value to this option? Should I be even worrying about it? Check that word, exclusivity. Is there enough exclusivity that I can apply option pricing? And third step, you decide to put a number on that option. You want to bring out option pricing. Remember, you need replication and arbitrage. The further away you get from that, the more dangerous it becomes to apply option pricing models. So now that we've laid that foundation, let's have some fun with options. I'm going to talk about 3 sets of options. And these are options that you see in almost every project, more in some projects than others. So let's start with basics. If this were a corporate finance class, you're doing a capital budgeting project, you take the expected cash flows, you come up with a discount rate, you take the present value, you come up with the net present value. If the net present value is greater than 0, it's a good project. It's less than 0, it's a bad project. There's nothing wrong with that statement, but it's a statement at a point in time. The first option we're going to talk about is the option to delay. A project that is a bad project today could become a good project in the future. Markets can change, technology can change. We're going to start with that option to delay. We're going to apply it in 2 contexts. One is to value a patent that you've just acquired as a company. Say, hey, you got an option to delay. You can convert this patent into a commercial product, but you don't have to. It's your option. We value a patent as an option. I'm also going to use this option to delay to argue that if you came to me with an oil company, let's say Petrobras. Let's face it, 60% of Petrobras's reserves right now probably not viable at a $45 or $50 oil price. That doesn't make them worthless. You have an option to extract that oil. If oil prices go to $80 or $100 per barrel, those options could become very valuable options. I'm going to argue that natural resource companies, those undeveloped reserves, not the developed ones, but the undeveloped reserves, take on the characteristics of an option. So we're going to start with the option to delay. Then I'm going to move on to options to expand. You're entering a market where you know you're going to lose money. You're saying, why would I do that? Am I crazy? Not necessarily. You might enter that market because if you succeed in that market, you might be able to do greater things. Go big in that market, come up with new products. You could argue there's an option to expand. And the third and final option I'm going to talk about is the option to abandon, where you see a project starting to melt down in front of you, and you have the option to walk away from that project. I'm going to argue having that option to abandon is going to potentially make a bad project into a good project. So in all of these, you're trying to essentially look to see you're hitting a tipping point where an investment that looked bad on a net present value standpoint could potentially become a good investment. So let's start with the option to delay. As I said, with every one of these options, I'm going to go through the same sequence. I'm going to draw a payoff diagram so you can see what the option looks like. Then I'm going to show you what the underlying asset is, what the contingent payoff is, because once I do that, I'm set to value the option. So here's how the option to delay works. There's a project, and I give you exclusive rights to this project. Right now, the project has a negative net present value. But this project could potentially become a good project in the future. You have an option to delay. Let's draw the payoff diagram. Essentially, you can take this project anytime you want. You have the exclusive rights. The investment you will need to take the project becomes the equivalent of the strike price. You will take the project only if the present value of the expected cash flows in the project become higher than that initial investment. It's not right now, but it could happen in the future. But there's a very real chance that you could get these exclusive rights. A project could stay a negative net present value project, in which case what you lose is what you originally paid to get those rights. Recognizing that a bad project and the rights to that project are not the same thing is a big part of not messing up in lots of businesses. Okay? So let's take an example of how this plays out using a product patent as an option. If you're familiar with how the protections on patents work, in the US, if you get a patent, you get the exclusive rights to convert that patent into a commercial product. And it's amazing, the kinds of stuff you can patent. I'm amazed that they even let you patent some of the stuff that you do. But once you patent, you get the exclusive rights to convert that patent into a commercial product. Let's use some abstract language for the moment, then we'll come back and use an actual example to see how this plays out. Let's assume that the cost of converting the patent into a commercial product is I. It's known, you know what it is. And that the present value of the cash flows you would get by converting the patent into a commercial product is V. If V is greater than I, you will convert the patent into a product, make the difference. If V is less than I, you will sit on the patent and hope that something good happens. If I replace V with S and I with K, this S and K in an option, that's a call option. In fact, if I were to draw the payoff diagram on a patent, here's what it would look like. Converting the patent into a product will become the equivalent of the strike price. You will do that only if the present value of the cash flows from the product exceed the cost of converting the patent. And of course, that might never happen, in which case, what do you lose? You lose whatever you spent to get the patent. What are the two ways you can get a patent as a company? One is you can do R&D. R&D, in fact, is the cost of buying the patent. The other is you can buy the patent from somebody else, like Google did with Motorola, right? They bought the entire, you can buy a patent or you can invest. That becomes like the price you pay for the option. And you could very well end up looking back and say, I wish I hadn't done that. That's your payoff diagram. The underlying asset is the product that comes out of the patent. What I'm going to do is use that payoff diagram to kind of think about how I'd estimate the inputs I would need to actually value a patent. So let's say I came to you with a patent. I said, I want you to use option pricing to value the patent. Let's go input by input. Remember, there are only 6 inputs in an option pricing model. Let's see what those inputs would look like if you're trying to value a patent. When I ask you what the value of the underlying asset is, what's the underlying asset here if it's a patent? It's a product that's going to come out of the patent. Here's what I want you to do. I want you to sit down right now and project out the expected cash flows you would get if you developed the patent today. And you know what your defense is going to be? No, it's too much uncertainty. I said, that's good. Just make your best judgment. Give me expected cash flows. I'm going to take the present value of those so this is like a capital budgeting project. If you develop it, I get the expected cash flows. I discount them back at a cost of capital, or whatever risk-adjusted rate I get. What I get as a present value will become the S in the model. It's the value of the underlying asset today. Then I'm going to follow up and say, what's the variance in that value? Now you're going to be stuck, right? Because normally when I ask you for the variance in the price, what do? You go to Bloomberg, you check out the variance in past prices. But this is a project. You don't have any, you can't go and check prices. You can't go. So there are 2 ways you can get a variance if you're trying to use options to value patents. The first is you can do a Monte Carlo simulation. Remember how we did that for ExxonMobil, where we allowed the inputs to vary? And what you get then is a distribution of values. And actually, the output from a Monte Carlo simulation gives you the expected value. It also gives you a standard deviation. You can use that, but that's a lot of work. If you're lazy like me, I'll give you a second choice. If your patent is a biotech patent, you don't have the information or the capacity to run a Monte Carlo simulation. Here's what I'm going to do. I'm going to go find publicly traded biotech companies, hopefully younger ones, and I'm going to take the variance in their stock prices and use that as a variance in the option pricing model. I'm making a leap of faith here, right? I'm assuming that what you see happen to market prices just reflects what's happening to the underlying product. So if I can observe that variance, I can use it as the variance in my model. So 1 or 2 choices, either run a simulation or basically look up the stock price of publicly traded companies in that space. So I've got an S and I've got a sigma. Then I need a strike price. The strike price here is the cost of converting the patent into a commercial product, and you should have some sense of that. Do you have to build plants? Do you have to hire salespeople? So essentially, give me the cost of that entire infrastructure. That's going to become the strike price in the model. How long do you get to play this game? Until the option expires. So the life of the option is whatever the remaining life on your patent is. So you have 16 years, you get 16 years to play the game. So I've got S, I've got K, I've got T, I've got sigma, and the riskless rate matches up to the T. But here's a little problem you're going to run into. If you buy a listed option, let's say you buy a call option on Tesla. Why are you doing it? Because you expect Tesla's stock price to go up. Let's say it's a 6-month option. The stock price jumps tomorrow by 50 points. You have two choices, right? You made the right bet, so you're happy, but the two choices you face is you can exercise the option tomorrow and collect the cash flow, or you can sell the option. With listed options, what's always going to be the better choice? You're always going to sell the option because there's a time premium. So with listed options, we know that 99.9% of options don't get exercised early, that most of them last to that very last moment of the very last day because exercising early gives up the time premium. Now with real options, you don't want this to happen, and think of why. Let's say you have a patent for 16 years. Do you want to wait till the very last day of the 16th year to exercise this option? What do you lose by doing that? What's the power of a patent? It protects you against competition, right? By waiting till the last day of the 16th year, what have you done? You've given up all the protection. There has to be a cost here to you not exercising early. And I'm going to bring in that cost. It takes the form of a dividend in a stock, because what happens when you have a listed stock is when tomorrow is going to be an ex-dividend day, you actually see options getting exercised before an ex-dividend day. I'm effectively going to say that once this patent becomes viable, if you decide to wait, and it's your choice because you want more information, you want to make the product even better, you're going to give up something. And what you're going to give up is 1 out of the remaining 16 years of protection, 1 out of the remaining 15 years of protection that you have, and that becomes the equivalent of the dividend yield. In all of these real options, you'd see me try to bring that into the game, because if I don't, you're going to see the same thing happen with these options that you see with listed options. Nobody's going to exercise these options the very last moment of the very last day. So I've got every input I need for an option pricing model, and I could potentially value a patent as an option. You know, the biggest challenge with actually doing this with a patent is, if you're an outsider looking at a company, many of these inputs are unobservable. I mean, you've developed a diabetes drug. I have no idea what your cash flows look like. You know the insides of this market. So I'm going to use an example that's 20 years old, and the reason I've stuck with this example is I was able, purely through chance, to get my hands on the actual projections of cash flows that had been done by the company. It's a drug called Avonex. 20 years ago, Biogen, which is the company that developed the drug, had just patented the drug. It was approved, but they had the rights to develop it, but they hadn't developed it. So I decided to value Avonex as an option. It's a drug to treat MS. And as I go through the process and I think about it as an option, I want you to think about the consequences of treating it as an option in terms of, if you have MS, what this might do to whether the drug gets developed. So here's the first number I started with. I said, if Biogen develops the drug right away, what kind of cash flows will they get, and what's the value of the drug? Have you ever seen drug companies forecast cash flows for a drug? It's actually a very morbid exercise. Here's what they do. They start off with a percentage of the population that has MS. Then they look at the percentage of that population that actually goes to a doctor, which is not 100%. Then they take the percentage of the people who go to a doctor who actually get the right diagnosis, which is not 100%. Then they get the percentage of those people who get the right diagnosis who actually can get the drug, which is not 100%. So you could start off with 3 million people having MS, and your potential market could become 800,000. But they're pretty good at doing this because they've done this before. So what Avonex had done, what Biogen had done, is they projected out the cash flows for Avonex based on what they knew about the market. And the present value that they got from the expected cash flows from developing right away was $3.422 billion. So file that away. That's just the present value of the expected cash flows if they develop right away. Now, Biogen had never actually developed a drug and sold it on their own before. They'd been around for a while, but they tended to license their drugs to other pharmaceutical companies. A lot of young biotech companies often do that because they don't have the infrastructure to actually sell these drugs. But Biogen planned to make this their first drug that they would actually sell, which means they have to build the entire infrastructure, and the cost of building that infrastructure was huge, $2.875 billion. It's all those, if you ever gone into doctors' offices in the US, it's all these things that pharmaceutical companies give out as free stuff. The salespeople who visit the doctors, they have to build that entire infrastructure, $2.875 billion. Let me pause right there. If this were a capital budgeting exercise, I've just given you the net present value for this project, right? What's the net present value for the project? It's going to be 3,422 minus 2,875, which is 547 million. So if this were a static exercise, a DCF, the value of this drug would be 547 million. But remember, they haven't developed the drug yet. They have 17 years left to play this game. The riskless rate over that period was 6.7%. And we know the value is going to vary over time. Why? Because the markets change, the drug side effects can change, new things can. So to compute that variance, what I did was I cheated. I looked at other biotech companies that are publicly traded, and the variance in their stock prices is 0.224. I used that as my variance in this model. You're saying, why do you run a Monte Carlo simulation? I don't know anything about this market. What kind of distributions am I going to put on the number of people having MS and what percentage actually go to the doctor? If I were inside the company, I might be able to do that, but from outside, I had zero chance. So use that as my variance. Is this a viable drug right now? The present value of the cash flows is greater than the cost of developing the drug. It is viable. If they choose to wait, what are they giving up? 1 out of the 17 years of protection that they have left. So I'm going to treat that as my cost of delay. By not exercising the option, that's what you're giving up. That's essentially what the cost of delay does, is it puts in a cost of not exercising right away. I have all the inputs I need. I plug the numbers in, and I plug it in the Black-Scholes. Incidentally, purists in real options argue that the Black-Scholes is ill-suited to real options. And they're right. You know why? What kind of options is the Black-Scholes designed to value? European options. And when can you exercise a European option? Only at expiration. What did we just say about real options? You want to exercise early. So you're saying, how do you get away with it? Well, here's my defense. If you use a Black-Scholes model to value an American option, you're going to get too low a value because you're missing the option you have to exercise early. I'd rather have a conservative estimate of value from the Black-Scholes than try to do a binomial model with this drug. If you can do it, try it out, right? You've got to draw all those little branches. I looked at it and said, no way am I drawing a binomial model, so I stuck with the Black-Scholes. And the value that I got from plugging these numbers in the Black-Scholes was 907 million. What is the net present value of this drug? 547 million. By viewing it as an option, what have I done? I've added 3. Now do you see why people love real options? I just gave you a license to add 360 million, but there's actually a very dangerous consequence of this if you're suffering from MS. So in addition to giving you value for the option, what else am I saying about what Biogen should do right now? What happens if they develop the drug? The minute they develop the drug, the optionality disappears, you go to a traditional project. So you're sitting there saying, good, there's a drug that's come out that's going to treat, and Biogen's going to say, we've delayed developing the drug for a year, or 2 years, or 3 years, because we can accumulate more information, maybe come up with a better drug, fewer side effects. This is actually one of the consequences of viewing things as options, is sometimes, even though a drug is viable, you might not develop it right away because there is a benefit to waiting. If that benefit is greater than the cost, you will wait. So that's it with 17 years left. Let's say we move forward 1 year. Nothing changes in this process. What's going to happen to the cost of delay 1 year from now? Instead of being 1/17th, it's going to become 1/16th. You see what's triggered in this process? If I hold everything else constant, which is already a dangerous assumption, and I change the life left, you're going to see the cost. So there will be, and this is the good news if you have MS, is there will be a tipping point where you will develop the drug. Based on my estimate, it's not going to be for 8 years from now. But essentially it shows that when you bring an optionality, that the way companies will behave will change because the optionality kicks in. I'll complete the story. Biogen actually developed Avonex almost instantaneously. Saying, why? Were they being crazy? What's my cost of delay here? I'm saying it's 1/17th, right? What am I implicitly also saying? If I don't develop this drug, I've got 17 years of protection. What am I missing when I say that? Somebody else. I have a patent on the drug I have come up with to treat MS. I don't have a patent against all drugs to treat MS. What if I told you that Pfizer is working on an MS drug that's 4 years away from hitting the market? What's my cost of delay? It's 1/4. You put in a cost of delay of 1/4, very quickly you get the tipping point. So in case you feel, oh, this is horrible, pharmaceutical companies will never develop drugs, if there is enough of a comparative marketplace for different companies developing drugs, you will not get companies waiting because the cost of delay will rise high enough that the optionality disappears. But if you have a monopoly pharmaceutical company, you see how this is going to play out? You already have the ulcer drug in the market. You control 95% of the market. You've come up with a better ulcer drug. Why would you want to jump out and give it to the market right now? So you're actually going to see delay more often if you have no competition in the R&D space. Fewer companies are working on drugs to treat the same disease. Now let's extend this to valuing an entire firm. So basically I've talked about valuing one patent as an option. Let's say your job is to value a pharmaceutical company. Pharmaceutical companies might have 3 patents, 5, or dozens. If you're looking at a Pfizer or a Merck or Bristol Myers, you could be looking at dozens of patents. Now the way we traditionally value pharmaceutical companies, big ones, is we use the DCF model. We let the growth take care of the fact that we have all these things working through our portfolio. So you might look at Valiant and say, you know what, there's nothing in their portfolio, so I'm going to give them a low growth. That's what I did in my Valiant valuation. But let's say you decided that you wanted to bring this option pricing technology into your valuation. Here's how you could approach valuing a company. You could take a pharmaceutical company, take their developed drugs, which are already out there, which have cash flows, and do a discounted cash flow valuation of the developed drugs. So that takes care of that slice. Then you could take their patents, like Avonex, value each patent as an option, come up with that value, add it onto the value of the commercial products. You're almost there, but there's a third layer you now have to bring in. There's a continuing R&D department, right? Which might come up with new drugs in the future. You don't know what they will be. You have to make a judgment as to whether the value added by that R&D will be positive, 0, or negative. Now do you see why when we value pharmaceutical and drug companies, we tend not to go down this route, especially if you have dozens. If you have a small biotech company with one big patent, you can try option pricing. If you have Pfizer and you try this, you're going to go crazy. But I'm going to try with Biogen, because Biogen in 97 was small enough that I could pull this off. And in fact, here's what I started with. I started with their existing drugs, and they had 2 drugs that are already licensed out. And the licenses were fixed licenses. Basically, they got a fixed fee. As opposed to what, there are 2 ways you can license out a drug. One is you can license a drug out, get a fixed amount every year, or you can license a drug out and get a percentage of revenues every year. It's going to be significant because what discount rate I use on these cash flows will depend on how the licensing is structured. So in this case, it was structured as a fixed license, $50 million a year in after-tax cash flows every year for the next 12 years. So I need a present value, that $50 million, right? I discounted that $50 million every year, which is an annuity, at the cost of debt of the guaranteeing companies, the companies that bought the license. Again, it goes back to present value 101. The discount rate used on a project should reflect the risk you face from those cash flows. And in this case, what's the only risk you face? Is a Pfizer or Upjohn that has licensed this product might default. And because those were highly rated companies, then I could use their cost of debt. Now let's do some what ifs. What if Biogen had licensed these drugs out to the US government? I don't know, Medicare says, okay, $50 million a year. What would you have done differently in your discounting if the licensing had been to the US government for a fixed fee? What discount rate would you use? What's the risk you face then? That the US government could default. I would use the T-bond rate as my risk-free rate because that's the risk you face. What if I got a slice of the revenues instead of a fixed fee? What did you use as your discount rate then? Then we're talking about cost of capital because The risk you face is from the risk of operations. If I got a slice of net income, it has to be cost of equity. So play with the what ifs because it's going to get you more comfortable with what discount rate you use on a cash flow. And it extends beyond this example because it's something that you commonly see misconstrued is people use the cost of capital everywhere when in fact they shouldn't. The present value that I get for those for 50 million a year for the next 12 years is 397 million. That was my first slice. For valuing the future R&D, I had to make some assumptions. So here's what I did. Biogen had spent 100 million in R&D in the most recent year. I assumed the R&D would grow about 10%, in this case about 20% a year for the next 10 years. So it'll go to 120, 144, etc. for the next 10 years. So I know how much they're going to spend. But we know already from our discussions of growth that just investing in growth doesn't create value. It's what kind of return on capital you make on those investments relative to your cost of capital that creates value. So I had to make a judgment call. And I'll tell you the basis for this judgment call. But what I assumed was every dollar invested in R&D creates about $1.25 in value. The way I got this was I looked at the return on capital collectively for pharmaceutical companies relative to their cost of capital. I'll give you what would have made my life really easy. If the return on capital for pharmaceutical companies was equal to the cost of capital, what's the value added from R&D? We're making the cost of capital. So then I'd have said $1 in R&D creates $1 in value. R&D goes away from the process. At the time that I did this, the return on capital for pharmaceutical companies was about 4% higher than the cost of capital. I converted into $1 value. So basically all you do is you take $1, you invest it to earn 14% with a 10% cost of capital. What you get as a present value is about $1.25. That's $1.25 that I'm going to use to come up with my estimated value created every year. And then I'm going to discount this additional value back to today. And this is a really risky cash flow because I have no idea what's going to happen. So what I used as my cost of capital was 15%, which is the cost of capital for a small pharmaceutical company, saying this slice is going to add value, but I'm really uncertain about where this value is coming from or how much it'll be. So every year I take the R&D, multiply by 1.25 to come up with the value of the patents. It's the differential that I discount. No, you can already see that if I assume $1 in value from $1 in cost, this is going to disappear. What I get as a present value from future R&D is 318 million. I'm way out on a limb right now, but might as well keep walking. What's the worst that can happen? I can fall off the end. So what I have now are three numbers. I have the 397 million, which is the developed product, which is the value from the existing products licensed out. 907 million, that's the value of Avonex, plus the 318 million, which gives me a total value for Biogen of 1.622 billion. Think of this as the replacement for the present value of free cash flow to the firm I would have done in a traditional DCF valuation. I'd add cash, subtract out debt, subtract out equity options. I can get a value per share from this value. At least at the time that I did this, Biogen's net debt was close to zero, so it wasn't a big issue. And there are no equity options outstanding, so my value per share was just that 1.622 billion divided by the number of shares outstanding. So we have a really small biotech or pharmaceutical company. You can try this out, but you can already see why it's going to stretch the limits of your assumptions, especially that slice about R&D. About a year ago, I actually did a post on what's happening with R&D at drug companies. And what I did was I looked at sales, the incremental sales divided by the R&D each year. In other words, I wanted to say how much is R&D paying off as higher sales? Because eventually, if you're spending all this money in R&D, it should show up as higher sales. In the 1980s, that number was about 15 cents. $1 in R&D would increase your sales, annual sales by 15%, 15 cents. That number dropped to 9 cents in the 90s. It dropped to 4 cents in the last decade, and now it's less than a cent. It's actually a very, very negative perspective on R&D because it says the payoff to doing R&D is dropping off at pharmaceutical companies collectively. And you see this in the struggles of companies like Merck and Pfizer. And guess what companies do when they find that the way they created growth historically is not working? They go try to buy growth. That's why you're seeing acquisitions pick up in this space, because traditional pharmaceutical companies are saying it's not working anymore. We're spending money in R&D. We're not seeing a payoff. So any questions on valuing a patent? Yes?
Is this because you're looking at mature companies rather than when you were looking at 20 years
It's the entire sector is mature. And that's something we have to keep in mind, because often you'll see somebody valuing a company in a high growth sector and they get really excited. This is a high growth sector, so I can put 20% growth and 30% return on capital forever. Forever is a really long time. Sectors, as they age, start to show these characteristics. Drug companies in the 1980s lived in a world where they had absolute pricing power, because insurance companies just passed it through. There was no pushback. They lived with absolute pricing power. Today, as the sector, so part of this is just the macro environment has changed, right? There's more pushback now because Medicare and Medicaid account for 40% of all the buying, and they're going to say, look, I'm not paying $8,000 a drug. And you're seeing this play out this year with the pricing of drugs and the pushback you're getting. So I think the game is changing, and R&D companies, pharmaceutical companies are starting to recognize it. Any other questions? So let's pass this through the test. Let's see if we're even on solid ground. Was there an option? Sure. The option was on the underlying product from the patent. And the contingency was the present value of the cash flows exceed the initial investment I'm doing it. So that passes the test. It's a pretty easy test. Is there exclusivity? To the extent that the patent law is enforced, there is exclusivity. So if you have a patent in a country where it's not enforced, or you go and sue in court and it takes 35 years for the court to decide, what happened to the value of the option? It very quickly dissipates. So exclusivity comes from the fact that you have patent law and it's enforced. And thirdly, can I apply the option pricing model? What do we say you needed for the option pricing model to work really well? You need the underlying asset to be traded. You need the option to be traded. What's the underlying asset here? It's a drug that to treat MS. There's no way I can trade that. There's no way I can trade the patent. This is about as far as I'm getting from the right set of parameters for an option pricing model, and I'm pushing through, which means I have to be really cautious about the numbers I get. Because if I go out there and try to sell Avonex to somebody for $907 million, show them the option pricing model, they're not going to be impressed. They might say, I'll offer you $575, maybe a little bit more than the $547. But it's tough to monetize the value of the option because you're stretching the limits of the model. So now let's talk about applying this to a natural resource company. If you look at a natural resource company, an oil company, a gold mining company, a coal mining company, whatever the natural resource company is, you can divide a natural resource company into two slices. First is they have developed reserves from which they extract oil or extract gold, they sell it, they get cash flows. That's pretty conventional discounted cash flow valuation. And then they have undeveloped reserves. Let's assume the cost of developing those undeveloped reserves is X. And the present value of the oil that you think is under the ground, given whatever price assumptions you have, is V. If V is greater than X, you develop the reserves and you get the oil out. If V is less than X, you sit on those reserves and hope that something good will happen, which in this case is prices going up. So let's think in terms of payoff diagrams. The cost of developing the reserve becomes the equivalent of the strike price, right? The value of the oil under the ground becomes the equivalent of the stock price. And if the value of the oil under the ground never exceeds your strike price, then you give up whatever you paid to get these reserves. And again, you can get them in one of two ways. You can do exploration, just like R&D, and come up with the reserves. The other is you can buy the reserves from somebody else. So if you have a lot of reserves with $100 oil price is what you need to break even, you might just sit on these reserves for the next 12, 14, 15 years and nothing good can happen. In most cases, you don't get the reserves in perpetuity. So if the US government often auctions reserves and I go bid for those reserves, I'll get the rights to extract oil from Alaska for the next 20 years. But at the end of 20 years, it reverts back to the government. That becomes the life of the option. So let's set up the parameters again. The equivalent of the stock price will be the value of the oil under the ground. How am I going to get that? I hire all these geologists. I pay them a lot of money. They tap the rocks and they say, you know what, there are 100 million barrels. They seem to be pretty close to the truth. So I'll take the 100 million barrels. I'll take the oil prices that I have right now, and I can take forward prices if need be, and I will come up with expected cash flows from developing the reserves today. That becomes the S in the model. The equivalent of the strike price becomes the cost of developing those reserves, and guess what? That's going to be different in different parts of the world. You're Aramco, the cost of developing reserves for you might be $5 a barrel. Why? Because in Saudi Arabia, you stick your finger in the sand, oil comes out. If you're a Canadian oil company, you might have to go 5,000 feet under the ground, get the oil out and unfreeze it. It might cost you $50 a barrel. That becomes a strike price, and you can already see it's going to vary depending on where those reserves are. The time to expiration is however long you get to play this game. Now, how many years did I give you the chance to play this? And if you can work it out, great. If not, you have to make your best judgment. The variance in the value of the underlying asset. If I assume that the number of barrels of oil under the ground is known and given, let's say I trust my geologist completely, what's the only variable that I'm uncertain about? The price of oil. You see the advantage in valuing this option that I did not have when I valued a patent? With a patent, I said, you have no way of estimating the variance in the value of Avonex, but can I estimate the variance in oil prices? And that I can check on Bloomberg, because you have spot oil, you have Brent crude, you have this, you have all these dozens of historical time series. So now I'm actually on much more solid ground. That becomes a variance. And of course, I'm cheating here. I'm cheating because I'm assuming that I know how much oil there is in the ground, and I know what it costs me to develop those reserves. If you're uncertain about those two, then you have to add that variance onto the variance of the price of the oil, which means your variance gets larger. Here again, I have to introduce a cost to delay. So let's say right now, you're ExxonMobil and you have reserves, and this is not even an assumption, it's true. You have reserves where the cost of developing the reserves is $25. Oil price is 48, 50, whatever it is today. These reserves are viable, right? So why doesn't ExxonMobil go in and extract all the oil out at the $25 and sell it into this market? Two games, right? First is you're hoping that oil prices go up to 75. So by waiting, you're saying maybe I can sell it. The other is if you try to extract all of your oil from these reserves and try to sell them all into the market right now, what are you going to do to the oil price? Then you're going to push the oil price down. So in a sense, there is this benefit to waiting, but there is a cost, which is by not developing these reserves, you're giving up some cash flows you could have got from developing the reserves. I'm going to compute that as a percentage of the value. That's going to act like a dividend yield. So the more in the money your reserves become, the greater the cost of not developing the reserves. So I'm constantly prodding you, saying, do you want to develop now? How about right now? And finally, there is this small detail, or perhaps big detail with natural resource reserves you have to bring in. Let's say oil prices jump to $100 a barrel tomorrow. It can happen. The oil market is crazy. And at ExxonMobil headquarters, the CEO picks up the phone and says, develop all reserves right away. Does oil start coming out of the ground the next day? First, there have to be people on the other side actually listening to the CEO. So by the time that gets to those people, it might be, a month into the process. Then they all run out with their rigs and whatever they do. I don't know enough about the oil business. And about 2 years from now, if you're lucky, the oil starts to come out of the ground. You're saying, so what? What triggered this development decision? That oil prices went to 100, right? By the time the oil actually comes out of the ground, oil prices might be back down to 45. So first you have that risk you did not have. Because when you exercise a call option in IBM, it's instantaneous. When you exercise this option, it might take you time. So I'm going to bring that in as a lag between the time you make the decision and the oil comes out, and that's going to reduce the value of your option. So let's try this with a company. Again, I'm going to go back in time because some of this information can be really tough to get, and I'll talk about what you can get from oil companies today and what I wish they reported. This is actually a valuation I did of Gulf Oil in the 1980s. When it was targeted in an acquisition, it was targeted because there are a lot of undeveloped reserves, 3.038 billion barrels of undeveloped reserves. The cost of developing the reserves at that time was about $10 a barrel. So if you decide to collectively develop these reserves, it will cost you about $30.38 billion. The oil price was $22.38 at the time that I did this. And the variable cost was $7, which means for every barrel you were extracting, you made about $15.38. The risk-free rate, the T-bond rate then, was 9%. Very different time in history. And if they developed these reserves, the cash flows they would get each year would have been about 5% of the value. So this is what you're giving up by not developing the reserves. The average life of these reserves, because they varied across the world, was about 12 years. So I'm going to try to value these undeveloped reserves first as a traditional DCF and then as an option. And let's think about where the additional value is coming from. I took the 3,038 million barrels and asked a what-if question. What if you developed all these reserves right away? Well, you're going to make $15.38 a barrel. You'll have to wait 2 years. So the development lag basically reduces the value because you've got to wait 2 years to get there. And what I get as a present value is $42.38 billion. That looks like a discounting, but what I'm effectively taking out of the cash flows in the first 2 years, 5% in year 1, 5% from year 2. My present value of cash flows, if I develop right now, is $42.38 billion. The cost of developing these reserves is $30.38 billion. Let me pause right there. If this were a DCF valuation of these reserves, 42.38 minus 30.38 gives me a $12 billion value. That's my DCF value for these undeveloped reserves. But remember, they're undeveloped. Gulf can wait to develop them. They have 12 years of life left. 3% variance in the oil, 0.03. If variances look small, it's because they're percentage squared. You have no idea what I'm talking about, right? Let's say your standard deviation is 20%. What's your variance? 400%, right? Let's say I take the standard deviation and express it in decimal form. What's 20%? It's 0.2. What's your variance? 0.2 squared is 0.04. So when you see these really small numbers and variances, that looks really low. That's because we think in standard deviation terms. 0.03 is a standard deviation of about 16 to 17%, which is what I ended up using in this valuation. With those inputs put in and a risk-free rate and cost of delay, I get again in Black-Scholes. I'm playing the same game. N of D2. So can somebody remind me what N of D2 measures? It's a probability that this option will be in the money, right? Which in this case is the probability that I will actually develop these reserves. There's a very high, no surprises there. It's an in the money option. The value that I get for the option is $13.3 billion. What was the value that I got from a DCF? $12 billion. The value that I'm getting from where's the extra $1.3 billion coming from? It's coming from the fact that oil prices are volatile. You can observe them. And you can adapt your behavior. You can produce more when oil prices are higher. That's what we're missing in a traditional DCF, is that extra $1.3 billion. In fact, if I complete this process, I took their developed reserves and valued them at the DCF. $915 million a year every year for the next 10 years. I get $5.065 billion. I add the value of these undeveloped reserves, $13.3 billion. What I get is my total value, $18.4 billion, is the equivalent of my enterprise value. So I can add cash, subtract out debt. The same process works out. Michelle?
What's the 12 years? Is that like they have a lease on the line?
Yeah, basically that's what it is. So it's different parts of the world, they have different leases. So the way you get these reserves in many parts of the world is you bid in auctions. And the auctions don't give you these reserves in perpetuity, they give them for a certain period. So the 12 years is the average life. So if you wanted to value an oil company using this particular approach, you can already see that you need the developed reserves. You'll have that information. You also need information on undeveloped reserves. Do oil companies report that right now? They actually do, but only a subset. You know what oil companies have to report? Viable undeveloped reserves, which in option terminology is what? Just your in-the-money options. If I were rewriting the accounting rules for oil companies, I would require them to report all their reserves, and in addition, give me information like average development costs by reserve so I can value it as an option. Right now, that's the biggest roadblock you're going to face. If you're valuing an oil company and you try to use this approach, the information is just not there. With Gulf, I got lucky because they dumped all the information out as part of that acquisition, but in most cases you don't. So let's stop there. When we pick up, we'll talk about the option to expand. 5% cash flow at a cost. So if you think about it's what I'm effectively doing is taking out the cash flows in years 1 and 2. So if you have a cash flow for the next 12 years, because I have to wait 2 years, I have to take the cash flow out. So that's just a shortcut I'm using, is taking out the cash flows. So if I did a DCF, the other way I could do this is put 0 in cash flows in year 1, 0 in cash flows in year 2, and then show the cash flows.
Yeah.
This is just a shortcut.
But what capital rate are you?
It's a cash flow average.
Just the cash
It's a
flow.
cash flow effect as a percentage. So I'm taking the cash flow year 1
Yes.
and dividing by the value that I have. So if my normal cash, if I were able to develop instantaneously, my cash flow in year 1 would have been 5% of my value. My cash flow in year 2 would have been 5% of my value. Because I'm not able to do that, I'm losing that 5% in year 1 and 2, which is effectively what that discount takes out.
Okay. Thank you.
This year with the valuation final exams, are you going to do another day for people?
Because it's so close to my last class. 16, my last class is the 14th, so only 1 day.
Yeah, but that's, I mean, I'm flying Thursday. That's why I'm.
Is that the 15th, right?
Yeah, but the exam is on Friday, right?
Right, but the last class is on Wednesday. So the only way you can do an early final then is to do it before the last. If you want to really do it, it's okay. Clean and consistent.
Thank you.
I had a question on the last example. So we discounted the 45 billion to 42, right? Because it takes 2 years
Discount.
lag.
Basically what you do is you take out the cash flows in the first 2 years. It looks like discounting, but that's just taking out the cash flow of 5% in year 1 and the cash flow of 5% in year 2. Because cash flows are 5% if you look at the problem itself.